Let me start by making a few comments about the global financial system and what we are trying to achieve in this session. What we are trying to do is to understand where we stand in terms of the changes and reforms in the global financial system and try to get an understanding of where this global financial system is heading and what it means for countries like Korea and other emerging economies in Asia. If we needed any reminder about the risks in the global financial system, we've had plenty of it in the last few weeks. There have been substantial volatility, gyrations, not just in equity prices, but in commodity prices, in currencies in the last few days. And just yesterday we had a massive move in the US markets. There are several issues that arise from this. First, for many emerging economies, and even for some of the more developed countries like Korea, there is a growing concern over the damage that what some term to be undisciplined flows of capital can cause to their economies. And there is certainly a push among many countries now, such as in Indonesia recently, Korea as well, Brazil, Taiwan, to introduce restrictions to try and slow the flow of these portfolio capital flows. Secondly, there doesn't seem to be a clear consensus on how to reform the global financial system so as to prevent another crisis from occurring. We have seen in the United Kingdom, in Europe, a push to introduce things like the bank levy, introduce restrictions on compensation to bank staff so as to address the issue of flawed incentives. But these still remain issues of contention and there is no global consensus. Thirdly, the recent flow of funds data in the United States and elsewhere suggests that some of the adjustment processes in the global financial system, such as deleveraging, are continuing and therefore continue to pose a risk to global economic stability. So we have a lot of issues that are unclear, and I'm sure at the end of it, my panel here will probably help you to clarify most of this. I don't think we can answer every question, but I hope we can end with some clarity on these key issues. So let me start first by inviting Professor Feldstein to give his views on the global financial system. Professor Feldstein.
Thank you very much. I'm delighted to be part of this session, as I was yesterday, to have the opportunity to talk about global economic issues to the larger meeting. Because I spoke about the economy yesterday, I'm going to focus my brief remarks now on some of the financial problems that we see in the United States and Europe, rather than the broader economic issues. But obviously, economic problems drive financial problems, and financial problems have important economic consequences. So I'm sure that during the discussion and in response to some of your questions, we'll be looking at some of those links. There is no shortage of important issues facing the financial markets now. I think there is substantial uncertainty and substantial fragility in the financial markets, both in the United States and Europe, and I'll just comment briefly on some aspects of that. Let me start with Europe. I would describe the situation in Europe as a mutually reinforcing problem between the banks and the sovereign debts. The banks are in potential trouble, and that will adversely affect government deficits and debt, and the government deficits and debt are already large and growing, and that's creating a problem for the banks. So that's the sense in which there is this mutually reinforcing problem. If you look at the banks in the peripheral countries, in Greece, in Ireland, in Italy, in Portugal, and in Spain, and those 5 countries, the banks have very substantial investments in the sovereign bonds of their own countries. It's estimated that the ratio of government debt to bank capital exceeds 100% in each of those countries. Now, normally, you would say, well, that's a safe asset, government bonds, and therefore, to the extent that the banks are invested in sovereign obligations, they have a cushion of safety. But over the last few months, we've seen a great shift in the attitudes about the safety of those sovereign obligations. So that now what that really means is that in several cases, and potentially more in the future, the value of those securities will represent significant losses relative to the capital of those banks. And therefore, ultimately, the government will be forced to provide financial support for those banks, and that will increase the riskiness of the sovereign bonds themselves. To be more specific, in each of those countries, we're looking at significant risks of potential default on their national debt. The extreme case, of course, is Greece. Greece has agreed to reduce its fiscal deficit from 14% of GDP last year to just 4% of GDP, and to do so in 3.5 years. A formidable, basically an impossible task, because the contractionary effects on economic activity in Greece are going to be so painful that I believe that the Greek government will ask for some kind of change in the structure of their external obligations, of their national debt. That restructuring or extension is de facto a default. The bonds will be worth less than they were when they were issued. That's already reflected in the market price, as well as in the difficulty that Greece has in borrowing. And so, if we think about the assets of the Greek banks or of the French and German banks that are holding Greek debt, those assets are worth substantially less than the par value at which they are currently on the books. And if Greece defaults, if Greece restructures its debt, it will raise a serious problem of contagion for some of the other high debt countries. How will politicians in Spain or Portugal explain to their publics that they have to take significant reductions in income, significant reductions in public services, and higher taxes in order to meet their fiscal targets when Greece has been allowed to restructure, Greece has been allowed to default? So the danger is that those other countries will also be writing down the value of their debt. That's going to be a serious problem for financial institutions, and it's going to come at a time when the capital requirements are pushing in the opposite direction. So the banks will see their capital eroded by the losses that they recognize on sovereign debt, and at the same time they will be called upon to have even higher ratios of capital. A related problem for the European banks will be the weakness in the economic activity leading to losses on commercial loans. I believe, as I explained yesterday, that the fiscal contraction, the fiscal consolidation policies that are being put in place throughout Western Europe will have the effect of slowing the growth in those economies, and therefore of pushing a number of those economies from positive growth to negative growth. The economies like Germany that export substantially outside the euro area will benefit from the weaker euro, but those that do not, including Greece and Portugal, those that do not will see a substantial reduction in their real incomes, probably negative GDP, and that's bound to hurt the profitability and the ability to service debt of their private corporations, that will weaken the banks, and the banks in turn will be dependent upon the government. One of the special problems that has occurred in Spain has been the sharp decline in real estate values and the potential losses on mortgages. When the government takes over or subsidizes mergers of the regional savings banks, the so-called cajas, when it does that, that will add to the size of the national debt and compound this problem that I've just been describing. As you probably know, there's an agreement to release stress tests describing the capital situation of the banks. It's not clear exactly what assumptions are going to be made, how rigorous those stress tests are going to be. But I fear, on the basis of what I've heard in discussions with bankers and authorities in Europe, that they're not going to be very persuasive. That the key question of how the sovereign debt on the balance sheets of those banks is going to be valued is not going to satisfy any of us. I understand in the most recent calculations, the assumption is that Greek debt is taking a haircut of only 4%, German bonds 1/4%. In short, they're not giving much credence at all to the risks of default that are already reflected in the market. So I think if they don't change that, if they insist on using very artificial values for the sovereign obligations on the balance sheets of the commercial banks of Europe, markets are not going to be at all happy with the result. They're not going to believe the result. Let me switch from Europe to the United States. And the good news in the United States is that the large banks are now in good shape. The small banks, however, are not. And the United States has some 7,000 small banks, and by small I mean banks with assets of less than $1 billion each. And those small banks serve the local and regional markets. They serve the needs of small and medium-sized businesses that don't have direct access to the capital markets or to the large financial Wall Street banking firms. So the fact that those regional banks are in trouble is a serious problem for the pace of economic activity in the United States. The problem for the small banks is largely a reflection, although not solely a reflection, of their commercial real estate lending. Their portfolios, in a word, are overweight commercial real estate. 30 to 40% of their assets, of most of these smaller banks, is in the form of commercial real estate. And commercial real estate had a price explosion, and that's been reversed. That bubble has burst, and those prices are down some 40%. So that when those commercial real estate loans have to be rolled over, the assets underlying those loans are not going to be worth the value of the loan. And the banks, therefore, will be forced to take write-downs in the size of their capital. To put that number in perspective, there are $300 to $400 billion of balloon loans, of loans maturing next year and each year for several years in the future. So it's a very serious problem for our local banks. Residential real estate still remains an important problem. Residential real estate, syndicated and direct loans, most of the loans are now being created by the government agencies, by Fannie and Freddie, but there are still large numbers of mortgages in the hands of the commercial banks. And the mortgages that, the homes with mortgages in the United States, 1/3 of them now have obligations, have mortgages that exceed the value of the home. And so we're seeing a high level of defaults, high level of foreclosures, and now that the special program that I described yesterday of government subsidies for home buying has come to an end, I think there is a risk that we will see further declines in house prices, and that will put downward pressure on the value of the mortgage assets held by our banks. There's a lot of interest in the so-called Volcker Rule and in the legislation that has just passed Congress, so let me comment briefly on that. The Volcker Rule was named the Volcker Rule after Chairman Volcker, who had been chairman of the Federal Reserve, by President Obama as a way of giving greater credibility to it. And in my judgment, it is a pair of changes in banking regulation that Paul Volcker has always liked, but really isn't fundamental to the crisis that we have just been through in the U.S. financial market. But it focused on two things which had the ability for the public to respond to it, for people to say, oh yes, that's right, that's the kind of change we want to make. One of them was the proposition that there should be no gambling with taxpayer money. How could you disagree with that? What it meant more concretely was limits on proprietary trading. And the other much more ambiguous proposal was there should be no bank that is too big to fail. Well, what has actually happened with respect to proprietary trading has been much less than an outright ban on it. In fact, the limits on the allowed proprietary trading in the legislation that is just about to pass the Congress, the Frank-Dodd bill, still leaves substantial scope for proprietary trading by the financial institutions. Probably only Goldman Sachs will be significantly affected, significantly forced to reduce the scale of its proprietary trading. Others will be able to continue a level of proprietary trading which is not insignificant. What worries me about the legislation that has just been passed is that while it attempts to reduce the amount of risk in our banking system, it will do two things. First, it will shift a lot of that risk from the banks to other less regulated parts of the economy, less supervised parts of the economy. And so in that sense, while it may make the banking sector less risky, it will not make the financial system as a whole less risky. And the other thing is that, the second thing is that banks being forced to reduce some of their risk-taking activities will ask themselves, well, if we now have a less risky portfolio, a less risky set of activities, and a lower return, what new things can we do? How can we change our behavior to take on more risk consistent with the rules in order to increase our profitability? So I think that what we will see will be increased risk-taking in the credit side of the banking business because it's much, much harder to regulate. So I think we will see portfolio risk reduced, trading risk reduced, but we will see increases in credit risks. Let me stop there. I think I've spoken long enough, maybe too long, and I'm eager to hear what my fellow panelists have to say about their views on the global financial system. Thank you very much.
Thank you. Thank you, Professor Feldstein. Can I now invite Dr. Yu to give his comments? Thank you.
My comments would be rather the implication of those international financial institutions to Korean economy and Korean financial system. Unfortunately and fortunately, as you know very well, around 20 years ago, Korean economy has a financial program. That kind of financial debacle created a new form of government regulation and banking sector, and also about soundness of Korean listed company. So that what the American and European government tried to reform their financial system is exactly what we have done a decade ago. So in that respect, we are ahead of other advanced countries. If you look at that equity ratio of Korean financial system and listed company, around 12, 13 years ago, that ratio, that equity ratio of Korean firm was as high as 300%. But that has been reduced to only 150 and 120%. So in terms of liquidity and also payout strengths is given to Korean firm. And if you look at their borrowing cost is better than other multinational firm and even better than Korean financial system. So that Korean and those big Korean firms do not need any money from banking system. That creates a little problem. Second one is that all Korean bank has been consolidated into. Around 2/3 of all bank has been dismantled and merged into new big Korean corporations. And even those Korean banks now has only, in terms of debt loan ratio, that's around 110%. As you know exactly, according to Basel III, one of the regulation will be shifted from bar to that loan ratio, which is around 100% by 2013. Already all Korean banks are keeping the incoming new regulation by Basel. So in that respect, it's very sound. And also, because of the problem in Korea in liquidity of foreign exchanges, even though the size of reserve of central bank was large enough, we thought, yet because of international fluctuation of capital market and financial market and even exchange market, created a lot of problem in terms of paying out those reserves. So after that, Korean government tried to build up the reserve, which is now $270 billion. That's 90% of imports. And then fortunately, last 3 years, Korean government has been very successful in establishing official currency swap with United States and other neighboring Asian countries. So that there are strong belief about the potential of repaying foreign exchange has been built. So if I say in that manner, Korean economy is very sound. And then among the OECD countries, Korea is the first country to be recovered. And as you know, in this year, we're expecting 6% of GDP growth. However, if you look at other side of Korean economy, we have many problems. I'm going to illustrate three major areas. One is real estate area. Like the 1990, Korean real estate has the booming. So the price has gone up. And then a lot of construction firms try to build up those kind of condominium and commercial buildings because the only expectation that price will go up and up. So we have already a glut of supply of those commercial building and condominium. Yet government has been very shrewd enough So that if you look at DTI, the loan to income and then loan to value is only 40%. So that as far as the price of real estate go down 100% or 50%, still the value of their mortgage is bigger enough. However, as I mentioned, if you look at the profile of Korean GDP and then also generation of employment, we are heavily reliant on construction industry. And then the rural area constructors have a lot of problem, so that is creating an employment problem and also the problem of liquidity in the rural area. That's one area we should study further and then work very hard to overcome the current Korean economic problem. Second one is that I mentioned Korean government, our central bank has $270 billion of reserve, which is good enough. Yet, if you look at the Korean capital market and foreign exchange market, it is small to larger size, in the middle size, which is quite often no restriction at all. So that foreign investors, especially those investment bankers, are utilizing Korean capital market or Korean exchange market for Cooper zone, buffer zone, linking between international operation and US or European operation. If they need liquidity, they start to sell off their investment in portfolio investment, or they start to sell up so that they are taking the money back to their country. So that not because of Korean economy, but because of this area has been used as buffer zone for managing their international portfolio. So Korea has become the victim because of its openness. And also, as you know, if you look at Korean economy, we are heavily reliant on export. It is growing, especially larger Korean exporters, including shipbuilders and the semiconductor, and those ones are having longer contract export, which range to 3 to 5 years. So whenever they have that kind of longer-term contract, they have to have hedge against a potential depreciation of US dollar against Korean won. So that they immediately go to a hedge won. In that process, foreign banks as well as Korean commercial bank have to borrow money from internationally US dollars. That is creating instability of fluctuation of Korean value against foreign countries, especially US dollars. Plus, yen carry or dollar carry. A lot of people are expecting that Korean won will start to appreciate from next year on, yet the interest rate is higher than US dollar. So that is definitely potential profit. So a lot of money is coming for that purpose because of two reasons, as I mentioned. One is that hedging purpose of Korean exporters, and the other one is dollar carry won. So Korean market has become very unstable. That's the second problem we are having in Korea. And another one is that now, if you look at the profile of GDP again, service sector is limited. Like the case of Germany or Japan, comparatively, manufacturing sector in Korea is larger. So as income become bigger and bigger, definitely the trend would be to service sector, including professionals and shipper, and also banking sector. In a sense, Korean domestic banking sector has been mature enough, yet there is less potential for growth. The problem is that because of image of Korean conglomerate, even though they are contributing to the Korean economy in many respects, still a lot of people are criticizing what they have done. So that we have very strict rule by which those Korean firm cannot invest into financial sector. So that the funding of those larger Korean bankers have been limited. So if you look at the profile of those banks, more than 60% of investors are coming from outside, not from Korea, not because of the money which Korean firms or investors have money, but because of the limitation of ownership, segregation between those big firms versus financial sector. Yet, if you look at the size of Korean firms, the largest one, for example, KB, which I will work for next week, if our investors allow me to work, that market share, is only around 23% to GDP. As you know very well, you look at the Swiss banks, UBS asset size is 350% of their GDP. Royal Bank of Canada, 50%, etc., etc. The size of Korean firm is small. Yet, because of American Volcker rule, now the issue is too big to fail phenomena here. That actually, if you look at the size itself, it's not big enough to compete with international financial institutions. That because of bad image against Korean big corporations, and because of that one, a lot of people have negative image about becoming bigger and bigger. As I mentioned, domestic market has been limited in banking sector, yet we have to go abroad because we have many advantages compared to neighboring Asian countries in China, Indonesia, Vietnam, etc., etc. But we have limitation because of a concept of too big to fail. That's my comment.
Thank you very much. I'd like to now invite Dr. Min to give his comments. Thank you.
I'm afraid I'm not a doctor. Professor Feldstein mentioned basically two big topics about, number one, global economy, and number two, about the currently going on financial reform. So my comments shortly would be on two areas. Number one, the global economy. Obviously, it's a concern, as Professor Feldstein mentioned, the contraction of European financial power because of the European government debts. In addition to that, U.S. economic slowdown from subprime mortgages and followed the commercial real estate portfolio kind of a thing is a big concern. However, one of the things that I'd like to mention is the Asian and emerging markets economic recovery, which is faster than expected. One example is Korea. Korea has overcome Asian crisis 10 years ago very much successfully. And 2 years ago, we have a Wall Street global financial crisis. Korea is the first country coming out from that adverse impact. And we are talking about European government debt concerns now. All these things gives more focus to Asia and emerging market growth will be offsetting potentially this global slowdown of the US and European economy. So Korea would like to take an opportunity of having this Asian focus, investment more into Asia and Asian growth. Korea would like to be one of the center, together with China, on this future economic locomotive for the global economic situation. Number two, about the financial reform and currently going on BIS discussions, including Basel III. These are basically, definitely there are merits of this kind of more regulatory intervention and regulatory reform. For example, the advantages includes number one, Obviously, this will reduce the system risk of the financial industry by strengthening banks' capital base and liquidity regulation. Number two, this will prevent excessive pursuit of risk for this financial industry. Number three, obviously this will encourage responsible management and more sustainable financial stability to banking industry globally. Those are the merits. But what we have to look for is what are the other side potential adverse impacts of this kind of reform to be worked. Number one that people mostly concerned about is this will cause credit contraction due to forced deleverage of most of the financial institutions, which will result in higher financing costs. And then this will lead to lower economic growth globally. So how are we going to offset this kind of negative impacts? Number two, this kind of a framework of a regulatory reform, whether will further discourage financial innovation, which had been one of the locomotives for financial industry development so far. So this will also to be addressed. Number three, as Professor Feldstein mentioned, the possibility of adverse selection, meaning that because of the lower profitability of these financial institutions, then the management may choose somewhat riskier decisions, either in credit decisions or in other type of transactions. So how we can mitigate the possibility of this adverse selection kind of a thing. These three things probably would be the most concerns that I think would like to be discussed very seriously. My suggestion for better regulation would be three things. Number one, we need to prevent over-regulation. Obviously, there are many areas that have similar effects, but made a regulation from different angles. So we really need to be carefully sort out all these kind of concerns, so that we need to make it preventing over-regulation. Number two, when we have a regulatory framework, we should have better applicable, realistic guidelines, rather than just theoretical guidelines, because this might have a serious impact on global financial industry. Number three, my arguments would be we need to really clearly examine long-term effect of new regulations on real economy. If we are to make a regulation based on current situation on a short-term basis, that might have a negative impact in the long term on the real economy. So we have to consider balancing this long-term and short-term effects. My final comments from Korean perspective, especially from the impact of this kind of a reform from the Korean financial sector, might be we should have a consideration of respective countries' different and unique financial background and development stages. As Dr. Oh has mentioned, Korea has already adopted some of these kind of restrictive guidelines long years ago. And then we already have quite a restrictive regulation already compared to advanced countries such as US or European markets. Probably the regulatory constraints that we have in Korea is much higher. So if we just follow the global guideline, which will continue to strengthening the regulatory restrictions, probably that's unnecessary in many cases. I'm not saying that in all we don't need to. We have some we definitely need to have a discussion on, such as short-term foreign currency inflows and outflows kind of a thing. Definitely we need to have a discussion on. But in many areas, probably this is a great chance and opportunity for Korea to narrow the gap for our financial industry, both in commercial banking and investment banking, to reduce the gap of Korean financial industry global competitiveness, which is a little behind the global level at this moment. That's what I'd like to emphasize. Thank you very much.
Thank you, Mr. Min. And can I now ask Dr. Kim for his comments?
Thank you. Professor Feldstein made very important points, a couple of points, but I will focus on financial issues, especially in relation to the financial reform which is going on and yet to be completed in U.S. and the implications to Korean financial industry. Looking at the financial services industry in the world, we can see two totally different financial services systems. One is universal banking system. The other one is specialized banking system. In universal banking system, the commercial bank can engage in investment banking business in the same house. But under the specialized banking system, in-house operation of investment banking business is legally prohibited. Yes, each system has benefit and expenses of their own. But from systemic risk, I will concentrate on systemic risk. And the point I'd like to highlight is that the universal banking system has a very serious problem in terms of systemic risk. A typical problem is this. If they do the investment banking business in the same house as they do carry out in the commercial banking business, they finance the money through the deposit taking, which is usually sponsored by the taxpayers' money. On the other hand, they run trading units and invest in high-risk project, even exotic product. So from the perspective of individual financial institutions, this in-house operation of commercial banking and investment banking at the same time is very, very attractive. But when it comes to the system as a whole, the story is totally different. If they engage in the investment banking in the same house, they might increase systemic risk in the economy as a whole. That is the basic motivation, the financial reform in the global market, even the Financial Reform Act, so-called Dodd-Frank Act, is tried to handle. Then what about Korea? We need to reform in financial field. We need to take care of systemic risk. The answer is yes. But the more important point is the motivation should be different. The finance and economic, the situation in finance and economy is totally different here in Korea. In Korea, too little risk taking, too little prop trading at the small size is a problem. So of course we need a financial reform, but the direction is quite different, quite the opposite. The policymakers and regulators in Korea must remember that. So in US, so it's not completed yet, but still going on, the Volcker tried to separate investment banking business from the commercial bank. But as you know, the Frank-Dodd Act, the main motivation and philosophy and idea of Volcker was significantly compromised. So I'm not sure whether this act will be successful. We will see. But I think, for example, this Frank-Dodd Act was born with 3% genetic disorder. Why? Because they allow 3% prop trading from the commercial bank. I think they have some problems about this. 3% Some people say 3% is very significant. I don't think so. 3% relative to Tier 1 capital is not that much binding. The only binding company I think, I read the newspaper, Wall Street Journal, is Goldman Sachs. So, financial reform, I'm convinced this kind of reform act will contribute to reduce and minimize the systemic risk. But I'm not sure whether this will be quite successful in handling, taking care of this systemic risk. And my last point is that we must remember that Korean economy, Korean financial market, the degree of risk-taking and development stage is quite different. So from the perspective of Korean government and Korean financial industry, it's more important to design, to build up our own financial system architecture, which is appropriate for us. Thank you.
Thank you. Thank you, Dr. Kim. I'd like to pick up on some of the points Dr. Kim and the other panelists raised and ask Professor Feldstein as well as the other panelists a question that really, to me, strikes at the heart of all this reform process, and it is whether what we are seeing in the Dodd-Frank process, the BIS process, really tackles the roots of the problems. For instance, the BIS, in its study, noted several roots of this problem. It referred to flawed incentives, it referred to weak and overlapping regulatory jurisdictions. At the macro level, it referred to the buildup of imbalances and so on. And when I look at what's going on in these processes, it doesn't seem to me that the roots of the crisis are being addressed. Professor Feldstein, first.
I agree with you about that, and I think that Dr. Kim's comments brought that out very clearly. If you think about the crisis that started this in the United States, it was a credit risk crisis. It was a credit risk crisis in the subprime market, but more generally in the real estate market and in a broader class of assets beyond that. I remember talking with investors before the crisis began and saying to them, don't you think risk is being mispriced? Don't you think that in a wide range of asset classes, you're not getting enough compensation for risk? And the answer was often, well, yes, but I do get some compensation for it. I may pick up only 25 basis points, but if I don't do that, if I accept a less risky investment, then my competitors are going to show a higher yield. The ultimate investors who have given me their money to invest don't understand how much risk there is, so I have to take that risk. I have to take that risk, but I will be quick to move out when the time comes. But of course, not everybody can get out when the time comes, and the result was widespread losses as these markets deteriorated. But the key was credit risk and not proprietary trading risk. It was not the proprietary trading desks that brought about this problem. So I think Dr. Kim's emphasis on the distinction between universal banking and specialized banking was an important one to make. I know from my long relationship with Paul Volcker that he basically believes that commercial banks should be specialized banks. They should take deposits, they should make loans, and they shouldn't engage in other activities. And I think those other activities are often very important complements to the basic banking activity. For example, underwriting of securities. A corporate client comes to a major bank and says, I need to raise funds. if the bank can only say, well, we can make a loan to you and we can tell you to go and find yourself some other institution, some investment bank that will help you to issue capital, that seems to me to be an unnatural and inefficient way of dealing with the problem. So under current rules in the U.S., the commercial bank can not only make a loan to that corporation, to that non-financial corporation, but can also help them to issue equity, to issue debt, and that's an important part, I think, of the function of the financial institution. Similarly, for merger and acquisition activities, I think that that's part of the full service that a bank should be providing to its clients. Now, pure proprietary trading really doesn't play the same role in that, and therefore I think there's more justification for limiting the amount of proprietary trading. But as several of us have said, and as the press has reported, with the 3% of capital limit on the proprietary trading exposure, this is not a serious restriction for existing financial institutions in the United States, with the exception of Goldman Sachs, for which proprietary trading is a larger part of their business. And they could, if they are allowed to, revert back to being a non-bank institution. Call it an investment bank, call it a hedge fund, call it whatever you want. They would be an asset managing firm, including managing for their own capital. So I think that it would be a mistake to move back away from the kind of broad universal banking that we now have in the United States. And I think the Frank Dodd bill could have moved us in that direction, but fortunately didn't. Let me stop on that point at that.
Thank you. Dr. Yu, would you like to comment on the remaining risks in the global financial system because of the lack of reforms or whatever?
I think it is not a matter of regulation itself. I think the mindset is more important. And also if you look at, we mentioned about remuneration, it's skewed for financial sector. Simply, we have the symptom for that one is that MBA graduate from Harvard and Wharton, all those guys, bright guys, want to go to Wall Street. And 60% of MBA from Wharton go to Wall Street. Why? Because of remuneration. So we need the change. And that phenomena even could be applied to Korean sector, financial sector also. So I think I agree that the financial sector could provide with a value to the economy. I agree. And they could reduce the risk. But actually the value created by the financial sector is not big enough to pay that much of higher remuneration to the CEOs of Wall Street and City of London. And that's an important thing. And I'm going to talk about, Professor Feldstein mentioned about sovereign debt problem. Fortunately, in Korea, we don't have that kind of problem at all. If you look at total government debt to GDP, it's only 30% compared to other advanced countries. So we argue that Korean government didn't well at all, but actually it turned out they are doing pretty well than what Korean in general think about Korean government governance of the nation itself. And that's two comments I want to talk about. And another one is that nowadays Korean companies are quick enough to adapt to international flow and standard. One of example is that now most of the Korean firms are trying to take the IFRS, International Financial Reporting System, which is better than American GAAP, so that we are following the international law, not only in banking sector, but also in other important rules. That's one of the strengths of Korean economy, to adapt to changing economy. Thank you.
Thank you. Mr. Min, any comments on this issue?
Well, I fully agree.
Okay.
Not that much additional comments.
Dr. Kim?
As for the separation, like Frank Dodd Act, they tried to carve out risky business like principal investment and derivatives from commercial bank. In principle, I agree with them. In principle, I agree with Volcker and Vanessa Lincoln, the senator of Arkansas. He tried to carve out all the derivative business from the commercial bank, but she failed. But what I'm saying is too much confusion, chemical confusion is detrimental to the financial industry. I'm not saying financial integration is bad. So if you want to do the different kind of business, you can do this from financial holding company. So this is, I think, that's exactly what we are trying to do here in Korea, but that's the idea to engage in different kind of financial business. And if we take a look at the situation in Korea, Korea needs more innovation rather than regulation. So Capital Market Act, in Korea became effective about 2 years ago. But the basic motivation of Capital Market Act was to boost up investment banking, financial innovation, and strengthening investor protections. But partly due to the financial crisis, we cannot achieve the original goals we're trying to aiming at. So if we take a look at the performance past 2 years, the only area which has been successful was investor protection. I'm not saying that investor protection is not important. Investor protection is the most important one when it comes to capital market. But boosting up investment bank to make Korean securities firms more like investment bank rather than brokerage house, and boosting up financial innovation, I think there is no performance at all. So my point is to finding the optimal point in the spectrum of financial innovation and stability. We need to find the optimal point. We need to find our own optimal point to strike a balance between financial stability and financial innovation. My view is our own optimal point is more close to the right-hand side, like financial innovation, comparing with other countries like US and UK.
Thank you. You want to continue? Yes, please.
Yeah, I wanted to make two comments. First was to just emphasize what I probably should have said at the beginning, which is that I'm a great admirer of the Korean economy and of the success that the Korean economy has had, both over the longer term, the economic growth that has occurred over decades, and also more recently in the way that Korea handled the economic crisis. Back in 1988 and 1999, when the crisis hit Asia and Latin America, I felt that the situation here in Korea was unwarranted, that the Korean increased current account deficits were not comparable to those in Indonesia or Thailand or Mexico, but were basically a temporary phenomenon reflecting changes in the semiconductor market. And yet, because of what was happening elsewhere, particularly in Asia, there was a kind of contagion in which investors and the international institutions like the IMF treated Korea as if it were not any different from Thailand or Indonesia. And I thought that was a mistake. And I thought, and I wrote at the time and spoke at the time, in Korea that was really unwarranted and inappropriate. Let me comment on one other point that Mr. Yu made, and that is about the notion of too big to fail. And that on one hand, that's a desirable slogan, even if it isn't a very operational consideration. But what it has led to, as he's stressed, is restrictions on the ability of the non-financial sector to own or to have subsidiaries in the financial sector, and that in turn has led to increased foreign ownership here within the Korean financial sector. An unintended consequence of the too big to fail principle. And it shows how dangerous it is to impose regulations without thinking through what the potential consequences are for the system as a whole. It seems to me that there would be no harm in allowing the large, successful, well-capitalized, non-financial firms here in Korea to have financial subsidiaries with all of the appropriate rules limiting the flow of dividends from the financial to the non-financial part of the company under strict rules. But nevertheless, that would strengthen the financial system here in Korea, and is a reform that seems to me, as an outsider, deserves serious consideration.
Thank you. It just strikes me, listening to Professor Feldstein and the others, that this contrast is emerging, where in the developed or G3 economies you have limits on the use of fiscal policy, which means that from now on there's going to be huge reliance on monetary policy. So interest rates will remain ultra loose in the US, Japan, and Europe for a long time to come. At the same time, Korea's fundamentals, for instance, are improving dramatically. Interest rates in Korea will probably have to rise. And this is happening not just in Korea, but in many other emerging economies where economic recovery is strong, structural supply-side drivers of growth are very strong. And essentially what is going to happen is that there's so much liquidity being generated in the G3 economies, and this is going to flow potentially very damaging ways to other markets like Korea and so on. And this has been a problem with us for the last 15 to 20 years, and it still seems to me that there is no reform of the global financial architecture to tackle this. In this context, what should Korea do, or what should governments and policymakers in countries like Korea do in response to this risk? Professor Feldstein first.
Well, I think there is a risk. I think it is true that the Federal Reserve in the U.S., the ECB in Europe, and the Bank of Japan are all focusing on keeping interest rates essentially at zero in order to stimulate aggregate economic activity, and without consideration for the potential adverse effects on asset prices, adverse in the sense of creating potential asset bubbles again. There's certainly no risk of a real estate bubble in the United States now, but I think that it is possible, in fact likely, that the very low interest rates being pursued by the Federal Reserve and the commitment to keep those rates low for an extended period of time is leading to an overpricing of long-term debt and an overpricing of the equity market in the U.S. But these low rates in the G3 countries set by central banks affects not just the G3 countries, but also, as the chairman said, spreads out to other asset classes and other countries. There's not much that Korea or others can do to deal with the fact that low interest rates being set in global capital markets by the US and Europe and Japan are making it easier, cheaper, and more profitable to have high values for a variety of asset classes, from real estate to commodities like oil. But to a certain extent, financial markets are national. Not all loans, not all credits, not all asset pricing is run off the LIBOR or Federal Reserve set interest rates. So each country has to ask whether it's appropriate for it to have the interest rate that it has currently set. I think Korea did the right thing in bringing down its central bank interest rate to a very low level during the time of the slowdown and crisis here. It helped Korea to recover rapidly, but now that Korea is growing at about 6%, I think there is a good question as to whether the interest rate here is too low and ought to be revised. And I know that that is something that the central bank is focusing on.
Thank you. Dr. Yu?
Yes. As you know very well, keeping interest rate too low, too long is definitely very dangerous. However, also there will be danger that if, as Professor Feldstein mentioned yesterday, there are strong chances that we will have a double dip, which probability is more than 30%, 1 out of 3. Then economy like Korea, which has been exposed to international market, will have immediate impact. And actually the Korean government worry about that kind of situation. So maybe among the other alternatives, maybe maintaining interest rate low to long is dangerous, but we have a couple of months or 4 or 5 months more to watch the change of international situation. That's important consideration. Second consideration is that, fortunately, in a sense, Korea has become host country of G20, where we will discuss about the international financial architecture in November. Then as a host member country, if we initiate any movement without consensus of international members, then that's not a good way. You know, the Korean think keeping faith is very important. So that maybe there is another reason why we are hesitating to increase interest rate.
Thank you. Mr. Min?
Right. When Korea is in difficulty with the global financial crisis, Korean government is successfully handling those issues, not only fiscal policy, but also monetary policy. It's not only on interest rates, it's also providing a almost unlimited liquidity to the market, especially to small and medium enterprises, which comprises 98% of the employees in Korea, as well as some difficult industries. So it's not only monetary policy, but the government provides extensive liquidity to the market. Obviously, I agree, one thing, that we have to consider about that. If this continued to go, it may create a serious problem in the longer term. But one more thing that I'd like to emphasize is not only the fiscal policy or monetary policy, we really need a restructuring of major industries as well as financially difficult enterprises as well. Because if we are delaying this restructuring of some industries such as shipbuilding, shipping, and construction, as well as some small and medium enterprises. That creates inefficiencies continuously in the market, and then it will largely impact our global competitiveness after post-crisis environment. So I really would like to emphasize this restructuring to be done timely.
Thank you very much. Dr. Kim?
Manu raised the question of capital flows, so I will concentrate on that issues. Looking at the foreign exchange market in Korea, before I talk about foreign exchange, let me start with systemic risk. How to take care of systemic risk is the most important policy issues regardless of the countries. But the more important point I would like to stress is that the main source of systemic risk is different country by country. In US, the too big to fail problem, too much risk-taking of financial institution is the main source of systemic risk. That's why they are trying to handle that problem, take care of that issues. But what happened here in Korea, the main source of systemic risk is totally different. Without exception, every time we face with financial crisis, the financial crisis is coming from the outside through the FX and currency market. So, to achieve the policy goal, we need to build up a finance system, policies, and architecture which could take care of these issues. Current undisciplined inflows and outflows of the capital. Looking at the industry structure size, as you know, Korea is heavily dependent on overseas market. So as a small and open economy, we're really heavily dependent on overseas market. GDP, export plus import over GDP is over 80%, one of the highest in the world. But from the perspective of manufacturers, it takes such a long time, especially shipbuilding companies. It is a world champion, but it takes such a long time, at least 2 years, from manufacturing to delivery. So they need to hedging tools. What happened was that most of shipbuilding companies depend on FX and currency forward, which is delivered by the commercial bank. So which is partly responsible for short-term high leverage. So here's my 2 recommendations. First recommendation is to diversify hedging tools, to reduce the burden of a commercial bank. That's one of the ways to deal with this problem is to take advantage of the exchange-traded currency option and futures. Especially small and medium-sized companies can use that financial tools. And the other recommendation is to induce or sometimes force the importing industries like gas and oil refinery institutions to hedge their currency risk. In that case, in the market, through the relative power of FX forward sales and purchase, it will be netting by the market principles. Then why importing industries, manufacturers, does not try to hedge their currency risk? My view is that the industry structure, monopolized industry structure is partly responsible for this. If the gas price is going up last night, you have many experience. When you stop by the gas station, the price is already up. They can automatically transfer the price into the customers. That's the main reason, I think. They do not need to hedge their currency risk. So to deal with this undisciplined capital problems coming from the currency market, I propose 2 recommendations, 2 ideas. Thank you.
Thank you very much for those very interesting recommendations. We have some questions from the audience. These are specific to particular individual panelists. First of all, to Mr. Yu. You will soon take over KB Holdings. What are your plans in terms of consolidation and expansion?
I don't think this is right place and right time to mention about our bank's own one. But I strongly believe that those kind of important activity should be based on only to improve value of stockholders. If an action which the bank is going to take should be based on value creation of stockholders. That's my answer.
Thank you. There's another question for Mr. Min. What's KDB's mid to long-term goals in terms of globalization? Should KDB grow as a private sector institution and pursue M&A across border? Or should it pursue organic growth by taking over domestic financial institutions? And also, what are KDB's aspirations in terms of being an Asian investment bank? A lot of questions for you.
Well, as you know, KDB has been the government bank for the last 56 years of its history and has been the locomotive for Korean economic growth. Now, the time has changed, and maybe the Korean economy is already open to global economy, and we may not need the government policy bank that more. And the KDB's continued market involvement continues to create complaint from the private sector banks. Why? We are competing with the government bank, which is operated by people's tax payments. So that creates continuous problem. So the government made a decision to privatize KDB. What's our goal to be? We continue to serve as a development of Korean financial sector, development, gaining more global competitiveness of Korean financial sector to global markets. One example, we have a ratio called a TNI, which is a transnationality index, which is showing of reliance on overseas assets and overseas profit. Korea, unfortunately, currently is 3%. Compared to global financial institutions, which ranges of this TNI from 30% to 75%, example of UBS or Deutsche Bank, type of European banks. So definitely, KDB would like to look for overseas markets. We do not want to compete and create another competition in the local market. Because local market is already, we believe, is a red ocean rather than a blue ocean because of the severe competition. So KDB would like to go for overseas and continue to develop overseas growth engines, combining it with Korean economy, so Korea can grow not only from a domestic growth engine, but also from overseas growth engines as well. What kind of a capability we have? For example, KDB's global project finance capabilities related to social overhead infrastructure. KDB ranks continuously within number 13 in total project finance globally. But in terms of PPP, which is a public-private participation, we rank consecutively 3 years number 2 globally in infrastructure for PPP area. Now we are talking about nuclear power generation. We are talking about overseas various plants, overseas infrastructure projects. For example, in Asia, for the next 10 years, we have $8 trillion of infrastructure-related investments for the next 10 years, which yearly average amount of $800 billion every year. So looking at KDB's global competitiveness, what we have in project finance, we believe we can take a substantial portion of opportunities in these markets. Now, the second question was what we are going to be in Asia. Obviously, what KDB would like to achieve is having a combination with Korean overall competitiveness, not in financial sector, but also in manufacturing sector as well. For example, if KDB has a industrial complex project in India, for example, which is a establishment of a industrial complex in India, for example, that requires, number one, power generation, which Korea has a global competitiveness for power generation capability. We need to construct a expressway for that industrial complex. We have a construction company, which is a global competitiveness. We may also need a railroad, which Korean railway has a global competitiveness. We also may need a port construction, which we have a tremendous experiences of our construction companies. So what we would like to go is, together with our competitive manufacturing sector, we would like to go for overseas markets with combination and synergies from financing capability that we have. That's our goal, to go for Asian markets. And we have a longer-term view of within the next 10 years for 2020, which is year 2020. We would like to be within top 20 in the global market in some selected areas, such as project finance, which we are already in some areas of corporate banking, which we are quite near. Corporate restructuring, we are unique in Asia in corporate restructuring efforts. We have a long list of successful corporate restructuring, including many Korean corporations where they were in difficulties. That's our goal and vision to be.
Thank you very much. We're coming to the end of our session, so I'd like to ask each of the panelists if they have any brief concluding thoughts that they want to make, starting with Professor Feldstein, if any.
Well, I would say that the discussion that we've had this morning reinforces my very favorable impression about the management and forward-looking character of the Korean economy. I would, though, end with just one warning, one concern, because it's been a problem that has arisen more than once here, and that is, and we've touched on it in the panel discussion, and that is the extent of dollar obligations, particularly of the commercial banks. It is the obligations of the commercial banks in dollars that led to runs on the currency before, and I think that's something that has to be watched very closely by the authorities.
Do you?
I think this is very informative session, because unlike the seminar, which are composed of only Korean experts or professionals, some of the answers which you are expecting from this kind of session have been far different from consensus in Korea. Thank you.
Thank you. Mr. Min? Thank you. No. Dr. Kim?
From the standpoint of policymakers, regulators, and the CEO of financial companies, of course, we must consider and remember what's going on in the global market, what's changing. But we need to come up with our own policies, your own business strategies, which is best for us. Thank you.
Thank you very much. It's almost impossible to summarize what we spoke for 1.5 hours about, but I think I take two things away from this discussion. First is that the whole process of reforming the global financial system is still very much work in progress. There's still a lot of uncertainty, and therefore we should not expect to see the roots of the global crisis being fully resolved. Secondly, what that means, I think, is that there will be continuing risks for countries like Korea and other emerging markets. But I think Korea has shown the way for other countries on how to deal with these risks, which is to build internal resilience with the right regulations, getting the right basics right in terms of fiscal policy and the like. Thank you very much. You would agree with me. I think that the panelists have been extremely insightful, making very forthright views. Could you please join me in thanking them in the usual manner? Thank you.